if you locked in CDs back in 2023 or 2024, when interest rates were a little bit higher, when we had that higher inflation, and now they're starting to come due, should you be looking towards going for long-term bonds to try to get slightly higher returns now that this money's coming due? Or what else should you be doing for that with this extra cash that you've got? Should you be looking to put it into short-term CDs or short-term government bonds at these lower rates now? Or is the idea of getting into longer term bonds or longer term CDs still a low risk opportunity for slightly higher returns than we're currently getting? We're going to talk about what you could be doing with these CD money that's coming due and why long-term CDs or long-term bonds have more hidden risks than you could actually realize. And a lot of this comes down to the risks of inflation. I'm Nick Grose,
I'm Peter Grose.
and we're financial advisors with Grose Wealth Management in Fairfax, Virginia. And Peter's had an independent
Since 1994, I've been fully independent
as a
as a
financial
financial
advisor.
advisor. And so,
And we're a fiduciary family office,
yeah,
serving families in the Northern Virginia area as well as across the country. So let's dive into today. What we're going to talk about is what should you be doing with money you've got coming due from these short-term CDs that you might have locked in at higher interest rates. And now that we've got these lower interest rates, should you be considering longer-term bonds? We're going to explain why there's these hidden risks, mainly due to inflation risk that come with long-term bonds that you might not be getting fully rewarded for.
what Nick said is exactly what we see. We're seeing people who, when the rates in 23, 20 jumped with inflation, we had people that saw their portfolios, the market stuttered, and rightfully, they saw their CDs at the bank offering, 1 year, 18 months, 2 year CDs of over 5%. And they locked these in. And the problem is now those funds are coming due and they're looking and wow, short term rates have come down. And so they're thinking, and they see that the longer term rates are a little higher. And they're thinking, wow, if only I'd locked in when I was before longer than the 18 months. It's reinforcing this idea, which is not a good one. And it is actually proven through white paper research to be a bad idea. And that's what we're really talking about.
Yeah. So when it comes to longer term CDs or US government bonds, people often think if it's US government or a bank CD, they're extremely low risk, which is true. But in the short term, they're very low risk because inflation rates change relatively slowly. If you lock it in for 1 year or 6 months or 18 months, as they come due, you can just reinvest them into the next short-term one. But the longer-term ones, when you've got money locked in for such a long time period, you're locking it in at today's current interest rates. And the big risk is what happens if interest rates all of a sudden rise significantly. We've seen this happen in the past. When you see rates rise significantly very fast, the price of the bond goes in the exact opposite direction. So if interest rates significantly rise, say we get some new hit of US dollars being devalued or a lot of inflation, then the price and the current value of your bonds are going to drop by in similar correlation to the rise in interest rates, the price will come down.
Right. This is it. And I think that people get the wrong idea. It's hard to understand what Nick is trying to explain. Because if you say to yourself, well, if I buy a 30-year treasury, it's guaranteed. And if they're offering 5.5% for 30 years, or is that what they're offering?
I think right now it's 4.6,
Yeah,
4.7.
4.6. So let's say you lock in for 4.6, you're going to get $460 on a $10,000 bond for the next 30 years. And at the end of the 30 years, you're getting your 30 back, you're getting your your $10,000 back. Where's the risk? Well, let's just do the math on it because, like you say, Gene Fama in 1993 showed in white papers that the risk you're assuming is you're not being rewarded with like a 4.6% return. So an example, that $10,000 we just talked about, you're also aware of the fact that it's completely liquid. You can sell it anytime because treasuries there's a secondary market. You could always liquidate and get your money back. Well, you don't get your money back. Price after you've purchased it fluctuates with the market. So if you had a $10,000 bond paying 460 a 30-year like that, and interest rates moved, say, 1% upward with some inflation, well, now if you want to sell it then, now you're only getting about 8,500. And if it moved 2% which is not very much. Now your $10,000 bond, you could liquidate for about 7,400. And that's a big difference. And that's the kind of risk we're talking about.
Yeah, I mean, what it really comes down to is the trade-off. It's everything's opportunity cost. So if you're trying to look for what you should be doing with your money that you just had come due from prior CDs that you had at those higher interest rates, and you're trying to find something lower risk, you know, the white paper research of Fama French will show that short-term bonds or short-term CDs give you that very low risk kind of liquidity that you're looking for. And those can easily be rolled over. However, we don't want to be leaving dollars on the table. So a big decision comes down to how much money you want to put at work. And I guess,
Right. Well, I put it this
silly.
way. I always remind people that it's we don't want no risk, nothing ventured, nothing earned. Right. So we look for ways to invest our money and realize there's risk, and there's nothing wrong with risk if you're being rewarded for it. And the stock market has historically, the markets invested in equities throughout the world is historically proven that the returns outweigh the risk, the volatile up and down possibilities that you're taking. On the other hand, when it goes to the long-term bond that we're talking about there, the example of the 30-year bond, the 4.6% you're being rewarded with is not going to be rewarded for the amount of risk that you're taking for that.
Yeah, and there's this hidden risk with these long-term bonds. People think just because it's a bank CD
That's
or
right.
just because it's the US government long-term bond that it's close to being no risk.
Right.
Well, when you study finance in university, they talk about what is the risk-free sort of investment, and it's not a long-term bond or a long-term CD. It's a short-term
It's the T-bill.
T-bill.
US short-term.
That's like the considered zero risk sort of investment. Obviously, there is risks, but it's the lowest risk sort of investment that you can get in terms of finance classes in school and everything.
Right.
And yeah, like Peter said, the biggest thing is the trade-off between risk and reward. And yes, the stock market will have more volatility, more ups and downs, but you get paid off for taking that risk.
And
You get rewarded.
Historically, it's been handsome.
And it's been handsome, 8 to 12% if you're well
Long return.
diversified and not trying to pick individual stocks. And the long-term, long duration bonds or CDs, those take on a lot of risk that people don't realize. Most of it does come down to the risk of inflation. And we didn't have it that bad in the last few years. Since right after COVID, we saw some inflation. It got up to 5-6% in the US, which was crazy compared to the prior 20 years. We had like 1% for
Right.
so long.
As somebody as old as me can remember bad inflation in the 70s and such, and the early 80s. I think the young people really were just hearing stories about it, and then they saw this recent inflation has been a whole new thing to them, but they don't realize
It's a drop in the bucket compared to what you saw.
yes, and you don't know what it could do. If you look at countries like Argentina and other third world countries, you can see that inflation can be a lot worse and be so
Detrimental. Yeah.
yeah.
And that's the risk that people just often don't consider when it comes to short and long-term bond investing. We want to make sure that we're getting paid off for the risk we're taking. We want to take calculated risks. We don't want to just put all of our money into one or two big tech companies or some Dogecoin or one or two cryptocurrencies or something. We want to take calculated risks. You do that by diversifying in the stock market around thousands of companies
Right.
in the US, globally, small companies, large companies.
Right.
And then also, if you need to be taking out fixed income, you are living off of some of this money, you should have a little bucket of reserve there in something that's stable and going to be very low risk. And for putting together a portfolio for someone and you want to have some stability there, some low risk to be able to pay you out during retirement, you find that stability in that low risk sort of investments with shorter term government bonds. If we want to be taking on risk or trying to get higher returns, we don't look to long term bonds or CDs, whether it's government or corporate bonds. We want to look for those higher returns in the stock market because that's where we're getting paid off the most for the amount of risk that we're taking. The big actionable takeaway is you look at what Peter mentioned earlier, the Fama and French white paper from 1992 or 93, where they look at the risk and reward factors over
Using data back of the Ibison's data back to 1926.
Yeah. And the big thing that they find is that you don't get paid off with higher returns. You don't get rewarded for the amount of inherent risk you're taking with longer duration, longer term CDs or government bonds. You're taking on extra risk that is not going to provide you with that high of returns. If
Right.
you want to be getting higher returns, you got to take on calculated risk, which in this case, it's going to be diversified into the stock market, US and global. And then if you do want to be a little more conservative with your portfolio, it's much more worth it to be doing that through short-term government bonds. The shorter duration, you're not even close to as subject to the inflation risk that you're taking on with longer term bonds.
Right.
So the big takeaway would be if you've got money that you put into CDs or short-term government bonds back in 2022, 2023, 2024, when interest rates were a little bit higher, and now that money's starting to come due, and you're looking for where you should be putting that, where you want to be looking is shorter term government bonds that aren't subject to the inflation risk that you're taking on, or putting it into the stock market. And it can be scary during all-time highs that we're seeing kind of right now with the stock market, but you need to figure out a plan that will fit with your tolerance for risk and being able to stomach the ups and downs of the market while also still building a strong base of short-term fixed income, like short-term government bonds or short-term CDs. That's going to be that low risk, lower reward that you're going to be looking for.
Nothing stated in this recording should be considered financial advice. Always consult with a financial, legal, or tax professional.